Warren Buffett hardly ever panics when a new must-have appears. Ask yourself, why would a man who turned a failing textile mill into a trillion-dollar powerhouse let headlines tell him what to buy? That question gets to the heart of this video, and the answer is simpler than you think. People say Buffett doesn't care about trends. That sounds edgy, but it's not stubbornness. It's a commitment. He wants businesses that will still make sense 5, 10, and 20 years from now. The idea is almost boring on purpose. Buy something you understand at a fair price and wait. That's the backbone of his whole approach. He calls it a favorite holding period that's effectively forever. But don't confuse boring with stupid. This kind of patience quietly crushes short-term hype. So what does not caring actually look like day to day? First, he focuses on intrinsic value, the real cash a business will generate, not the price ticker. Second, he keeps a margin of safety, meaning he wants a buffer if things go wrong. Third, he stays inside his circle of competence. He invests in what he understands and passes on what he can't properly judge. That trio explains most decisions you see or don't see from him. It's not a moral crusade against trends, it's a checklist. Here's the psychology behind it. Trends pull people toward action. They trigger FOMO. Buffett's approach exploits the opposite impulse, calm analysis. He's famous for saying be fearful when others are greedy and greedy when others are fearful. That line isn't a platitude, it's a behavior template. When everyone piles into something, prices often detach from value. When panic hits, prices can fall below what a rational long-term owner would accept. That's when Buffett gets interested. But let's be concrete. People bring up tech as the obvious contradiction. Didn't Buffett famously avoid tech for decades? Yes. He avoided many technology bets because he felt he couldn't reliably value some of those businesses. Then he bought Apple, a company that, for him, looked more like a consumer products and services franchise than a speculative tech story. He treated Apple as a brand and cash engine he could understand. Later, when Berkshire trimmed its Apple stake, that wasn't hypocrisy, it was applying the same rules to a chain situation. He invested where the business fit his framework. He reduced exposure when the risk-reward shifted. That's rule following, not trend following. If you listen to his shareholder letters and public remarks, a pattern emerges. He repeatedly warns about speculation, high fees, and gambling on narratives. Berkshire runs with huge cash positions at times precisely because overpriced markets leave few opportunities that match his criteria. In plain terms, Buffett keeps dry powder until price and value line up. That's boring, yes, but it's also how investors survive long cycles and compound returns over decades. So when does he change course? Not on the basis of headlines. He changes when one of three things happens: the business fundamentals change, the price relative to intrinsic value changes, or new facts push the company out of his circle of competence. It's a measured reaction. Even then, he tries to act like an owner, not a trader. That's why his moves look slow to outsiders, because he's trading short-term excitement for long-term certainty. Now here's the twist people miss. Ignoring trends requires discipline, not passivity. You have to do the hard homework. You have to be willing to stand alone when everyone else is drunk on a new story. You also have to accept that you'll miss some rocket rides. Buffett himself has missed early gains in some high-flying companies. He's okay with that. He's not chasing the scoreboard, he's building a portfolio that survives and grows. The trade-off is intentional. If you want to apply this to your own life, start simple. First, define your circle of competence. What businesses or industries do you actually understand? Second, learn to value them roughly. What will the company likely earn and how stable are those earnings? Third, avoid short-term headlines as investment advice. Finally, practice patience. The market invents reasons to sell every day. Your challenge is to pick reasons to buy that survive time. Think about the benefits. Following trends often means paying a premium for excitement. That premium becomes a tax on future returns. Chasing the next big thing also increases the chance of getting caught in a crash. A patient approach reduces that tax and the risk. Over decades, small differences in price paid and how long you hold compound into huge differences in wealth. That's why Buffett's boring strategy looks magical in the long run. Before we wrap, remember this. Trends are tools, not masters. They can highlight opportunities or warn you of overheating. But letting a trend dictate your portfolio is the fast route to regret. Buffett uses discipline and simple rules to extract value from markets that are often irrational. That's the real lesson. Not that trends are evil, but that freedom from them allows clearer thinking. So what should stick with you? 1. Focus on durable businesses you can explain to a friend. 2. Buy with a margin of safety. 3. Don't confuse price noise for value. And 4. Be ready to act when price and intrinsic value cross in your favor. That sequence turns volatility from a threat into an advantage. If you like this breakdown, hit subscribe. I'll keep unpacking stories like this. And if you want a short checklist version of Buffett's rules to download, say the word and I'll put it together next. Stay tuned for more videos that cut through the hype and show what really matters in investing. Subscribe to get more content like this and stay tuned for videos that strip away the noise and leave the strategy.